So managing more assets efficiently. So what we try to do for our clients, and we have a mandate from them that we are allowed to rebalance on a quarterly basis based on an objective that they set. So last year, what you're looking at in the red, these are the asset classes in the red, all of which had a negative year last year in our portfolios. Collectively, it impacted client returns by minus 2.3%. Everything in the green had a positive return and added 4.6% to the return. So when I put the two together, I end up with 2.3% as a return. Not great, but 7% higher than the Morningstar Neutral Balance Fund for the last 12 months. Now, the key to that is the following. Remember what we talked about? You have to sell winners and buy losers. If we're doing this properly, every 90 days, we're recalibrating the portfolio. Money comes out of the green and goes into the red. And this works, absolutely works. It's probably the easiest free lunch you can get in terms of improving your returns. And you just completely separate yourself from this. Now, I want you to ask yourself, when you think about all of this stuff, are you Spock or are you Homer? So I've got a question for you. I'm going to reframe the story a little bit differently. I want you to imagine you're on the Star Trek Enterprise, and basically Spock has been elevated to chief wealth manager of the entire ship. So he's the head financial planner for everybody. And his first client is Dr. McCoy. So the conversation goes something like this. Damn it, Spock, I'm a doctor, not an investor. In which Spock is obviously playing three-dimensional chess, and he's looking at it and he's saying, Dr. McCoy, I've been analyzing your portfolio. Your stocks are down 20%. I'm selling your bonds, and we're going to buy a lot more stock. To which, of course, he says, are you out of your Vulcan mind? Because, of course, McCoy's just responding emotionally to the fact that he's already depressed about the fact that stocks are down. Why would he want more of them? And that's basically how we respond. So to behave well, you have to know yourself. You have to avoid overconfidence, but at the same time, embrace uncertainty. These are Minsky moments. He's a really famous economist from the 60s and 70s. And what he said was, if the longer something has been going up or been stable, the closer you are to a significant uncertain event. And think of it like avalanche control. So it snows and snows and snows and snows, and so nothing happens. And it keeps snowing and it keeps snowing, and then all of a sudden, boom, one more snowflake, and that avalanche starts. You have no idea what snowflake is going to be. And that's what happens. So the longer things stay stable, the more likely they are going to crater at some point in time, and the longer it lasts, the bigger the crater is going to be. You have to play the odds by avoiding loss aversion. You have to diversify in asset classes. That's free lunch. And accept pain. Unfortunately, it's just part of what happens when you invest. You're going to have some losses in certain parts of your portfolio on a regular basis. It's easy to just forget about them. So that brings us to something we would call déjà vu. Have we been here before? So the 4% rule is a rule that is used within the financial planning industry to say, okay, I've got a certain amount of money. What's the safe amount I can take out and not be worried about outliving my money? And it's become common in our industry to say you can take out 4% a year. So if you've got $2 million in savings, you could take out $80,000 a year and you won't run out of money. Okay, so this group of people decided to do some analysis on this. Now this, to be fair, is just stocks and bonds, and it's not what we do, but basically it's what most people invest in. And what I'm going to do is I'm going to take a look at the 4% rule at 60% stocks, right there. Now at 60% stocks and 40% bonds, which is what most people actually do, you only have a 50% chance of success that the 4% rule is going to work. In fact, even at 3% or a year, you're only at 74%. So basically, that 4% is too much. If you take out that on a consistent basis, you have a good chance that you're going to be, I don't know, looking for a janitor job somewhere when you're 86, because you will run out of capital. On the other hand, and this is another one looking at 100% equities, which is pretty aggressive, even there you have a 40% chance. It still wouldn't be enough to take out 4% a year without running out of capital.